All right, let's just dive right into this explainer. We're going to be demystifying the absolute largest financial market in the entire world. Seriously, if you've ever felt completely overwhelmed by all that dense financial jargon, or, just wondered how currencies actually operate behind the scenes, you're in the exact right place. Today, we're officially enrolling in the School of Pipsology, and we're going to decode the massive foreign exchange market step by step. So, here's a quick look at today's syllabus. First up, welcome to the Forex market. Then we'll meet the market monsters. After that, it's currency pairs and the tug of war, moving on to why the dollar rules. And finally, Forex versus traditional markets. Okay, let's jump right in. Section 1. Welcome to the Forex market, grasping the basics. Think back to the last time you traveled to another country. You probably walked right up to one of those currency exchange booths at the airport, stared at that blinking digital screen, and handed over your home currency for some local cash. And maybe, just maybe, you realized your $1 was suddenly worth like 100 Japanese yen, and you felt kind of rich for a second. Well, if you've done that, congratulations, you've literally already participated in the Forex market. And, if you had any yen left over on your way back home, you probably noticed the exchange rate had actually changed. It's exactly those continuous, everyday changes in exchange rates that allow traders to make money in this market. Now, because you aren't buying anything physical, like an apple or a car, trading money can initially feel, a bit abstract. But the absolutely crucial thing to remember here is to think of buying a currency as basically buying a share in that particular country's economy. So when you buy the Japanese yen, you're effectively betting that the Japanese economy is doing well and hey, it's going to keep getting better. The exchange rate is really just a direct reflection of what the global market thinks about the current and future health of that specific economy. Moving on to Section 2, meet the market monsters, understanding the scale. This brilliantly illustrates the ultimate David versus Goliath situation. Think about it. On the news, you hear about the New York Stock Exchange literally every single day. Everyone's always talking about the market being up or down, making a ton of noise. But if we represent the NYSE as a monster, it's really that loud, kind of puny green guy on the left. Compare that to the foreign exchange market. Forex is the absolutely ginormous, unstoppable blob monster just dominating the space. The stock market literally doesn't even stand a chance in comparison. Just look at the data. It reveals a completely mind-blowing difference. The Forex market boasts a staggering $4 trillion daily trading volume. $4 trillion. Contrast that with the New York Stock Exchange's measly $74 billion a day. Basically, the currency market is over 53 times bigger. Now, just to be perfectly accurate here, that $4 trillion covers the entire global market, while the retail spot market, which is where everyday traders play, that makes up about $1.49 trillion of that total. But still, the next time the media tries to tell you the stock market is the biggest game in town, you'll know the real truth. All right, Section 3, currency pairs and tug of war, how trading works. Okay, before you can really trade, you gotta speak the language, right? And Forex traders absolutely love their slang. Every currency has a three-letter symbol, like USD for the United States dollar, but they also come with these fantastic nicknames. So whether you're trying to make some Benjis or scoop up some Skrilla with the US dollar, maybe trade the fiber for the euro, or work the loonie for the Canadian dollar, you'll definitely need to know these major currencies. It really adds a whole lot of personality to what is otherwise a highly analytical market. Now, unlike buying a single stock, when you trade in Forex, you're actually simultaneously buying one currency and selling another. They're always traded in pairs, like the euro and the US dollar, which you'll see written as EUR/USD. I want you to imagine each pair constantly engaged in a massive financial tug-of-war. Each currency is just pulling as hard as it can on its side of the rope. Exchange rates fluctuate continuously based on which currency's economy is stronger and pulling harder at that exact moment. So most of the real volume happens in the major pairs, and those all include the US dollar. But you can also trade what are known as exotic pairs. And no, these aren't exotic dancers. An exotic pair is simply made up of one major currency paired with the currency of an emerging economy. Think the US dollar and the Mexican peso, or maybe the US dollar and the Thai baht. But, and this is a quick warning for the focus learners out there, because these exotics aren't as heavily traded, the transaction costs and the spreads, they're usually 2 to 3 times bigger than the majors. Let's hit Section 4, why the dollar rules, the king of Forex. The numbers here make it undeniably clear. According to the International Monetary Fund, the US dollar makes up a massive 62% of the world's official foreign exchange reserves. On top of that, the US dollar is on one side of a frankly ridiculous 84.9% of all reported daily transactions. Because almost every single investor, business, and central bank owns it, the entire world pays very, very close attention to what happens with the buck. So, the US dollar wears the crown. But why exactly is it king? Well, it really comes down to a few super solid fundamentals. The United States has the largest economy in the world, the largest and most liquid financial markets, a remarkably stable political system, and is the world's sole military superpower. Plus, it essentially serves as the medium of exchange for major cross-border transactions. For example, oil is priced in US dollars globally, meaning if Mexico wants to buy oil from Saudi Arabia, they literally have to sell their pesos and buy US dollars first just to make the transaction happen. The dollar is simply indispensable.
Moving into our final section, Section 5, Forex versus traditional markets, the ultimate showdown.
If we put Mr. Forex in the boxing ring with Mr. Stocks or Mr. Futures, honestly, it isn't even a fair fight. Just think about the stock market for a second. You've got roughly 4,500 stocks on the New York Stock Exchange and another 3,500 on the NASDAQ. That is a massive, exhausting number of companies to try and research. But in spot currency trading, the vast majority of the market simply focuses on the 4 major currency pairs. It's so much more streamlined, which really allows traders to focus deeply rather than spreading their attention across thousands of individual companies. When you look at the scorecard, it heavily favors Forex. First off, Forex is a seamless 24-hour market. There's no sitting around waiting for an opening bell. You can trade at noon or, honestly, in your pajamas at midnight. Second, spot currency trading completely eliminates the middlemen, meaning no clearing fees or exchange fees taking a sneaky cut of your profits. Third, unlike the equity market, there is no structural bias. You have equal access to trade in a rising or falling market. You can short sell without any restrictions. And finally, you get instant execution directly off real-time streaming prices. It's a game changer. Now, because this market is just so incredibly vast, traders and financial institutions have come up with a bunch of different ways to participate. You've got futures, which are standardized contracts to buy or sell at a future date. You have options, giving you the right but not the obligation to execute a trade. There are newer exchange-traded funds, or ETFs, which kind of blends stocks and currencies together. And then, of course, you have the spot market, which is the immediate exchange of currencies at the current real-time market price. For absolute beginners and everyday retail traders, the spot market really is the ultimate destination. Why? Because of its brilliant simplicity, those tight spreads we mentioned, and continuous round-the-clock operations. But honestly, perhaps the absolute biggest draw is the insanely low barrier to entry. In traditional markets, you need some pretty significant capital to get started. But in the Forex spot market, brokers let you determine your own position size. That means you can open an account with as little as a $25 deposit. Though let's be real, proper risk management dictates you should probably start with a bit more than that to weather the market's fluctuations safely. What's truly amazing here is that almost all online Forex brokers offer completely free demo accounts. These give you real-time news and charting services so you can practice with play money and build your skills entirely risk-free. It is, hands down, an unparalleled way to learn the mechanics of the market. So, you now know that the daily news obsessing over the stock market is completely missing the $4 trillion giant hiding in plain sight. The true pulse of the global economy isn't on Wall Street, it's in the constant, invisible tug-of-war of world currencies. The only question left is, how long until you step into the arena?